When it comes to money, many of us associate it with the hard work we put in. We imagine ourselves toiling away at our jobs, whether it's typing furiously at a desk or engaging in manual labor on a construction site from 9 to 5. There's no denying that our physical efforts can impact our income. However, it's important to recognize that money also has various psychological dimensions that often go unnoticed. These mental aspects play a significant role, influencing our spending habits and even our ability to increase our earnings. So in this video, I'll share 5 powerful psychological money tricks that you absolutely need to know. By understanding and utilizing these tricks, you can gain better control over your finances and achieve your financial goals more effectively. Now, let's start with a situation where your mindset might be negatively impacting your financial well-being. Money, in essence, is interchangeable. Every dollar holds the same value, regardless of its source or how it is stored. However, our brains tend to overlook this fact, causing us to treat different types of money differently. We might be inclined to splurge when we receive unexpected windfalls, while being more cautious when spending physical cash compared to using credit cards. For instance, think about the last time you received money as a birthday gift. How did you use that money? Did you save it for the future? Chances are, you saw it as extra cash and indulged in buying that new phone or gaming console you've been eyeing. But remember, as we mentioned earlier, money is fungible. The $200 you received as a birthday gift holds the same value as the $200 you earned from your regular job. The only difference lies in their sources. Falling prey to flawed mental accounting can lead to unwise financial decisions. However, the good news is that you can leverage this mindset to your advantage. One way to make the most of mental accounting is by creating separate savings accounts, each earmarked for a specific financial goal. Imagine having accounts labeled as vacation, car repair fund, or home down payment. Online banks and credit unions often offer convenient options for setting up and naming multiple subaccounts without imposing minimum balance requirements or fees. By labeling and segregating your money, you can create a psychological barrier that discourages impulsive spending. While you might be tempted to dip into a general savings account for an unnecessary purchase, you'll likely think twice if it means compromising funds for your dream vacation or being unable to cover a necessary car repair. Imagine you're just about to finish your meal at a restaurant and you start calculating in your head how much tip you should leave for the waiter. You feel confident about your decision, but as the waiter hands you the bill, they slip a small candy onto the table, thanking you for being a wonderful guest. If you've ever found yourself in this situation, you've unknowingly fallen victim to what psychologists call the reciprocity effect. This fascinating concept was introduced by Dr. Robert Cialdini in his book, Influence: The Psychology of Persuasion. It explains that when someone does something nice for us, we naturally feel compelled to do something nice in return. Now you might think that a mere mint won't have any influence on the tip you leave at a restaurant, but research suggests otherwise. Studies conducted by Dr. Cialdini himself have shown that when servers bring the check to their customers without a mint, the tip amount is typically based on the perceived quality of service. However, when a single mint is added, the tip increases by around 3.3%. And if 2 mints are given, the tip skyrockets to approximately 20%. It's not just waiters who benefit from the power of reciprocity. Retailers have also used this effect to their advantage. Retailers often provide customers with gifts or discount coupons, triggering a sense of inner guilt that compels shoppers to spend money after receiving such a seemingly kind gesture. This phenomenon taps into our desire to be consistent with our good nature and treat others as well as they treat us, even if it means our wallets become a little lighter. But here's the exciting part. You can actually leverage the reciprocity effect to boost your own earnings. If you're running a business, it's quite simple. Let's say you operate an online marketing company specializing in improving search engine optimization for other businesses. By offering them a free audit of their corporate website and providing valuable insights on areas they can improve, you've already delivered upfront value that triggers their natural inclination to reciprocate. This reciprocity can manifest in various ways, such as hiring you for additional work or referring your services to others in need. On the employee side, you can apply this tactic by going the extra mile for your boss. Putting in extra effort, staying late when needed, and stepping up whenever there's an opportunity will evoke a reciprocal response from your boss. When it's time for a raise or bonus, you're more likely to be generously rewarded for your dedication. So you see, while the reciprocity effect can potentially cost you money, if you know how to wield it strategically, it can actually help you increase your earnings. Think back to who you were 10 years ago, the things you valued, your likes and dislikes, and how you behaved. Chances are you've changed quite a bit. However, most people tend to believe that the person they are today will remain relatively unchanged in the future. This misconception often leads to decisions like getting a tattoo, taking on a mortgage, or getting married, only to later realize they might not have been the best choices. But here's the thing. The end-of-time illusion can actually work in your favor if you use it to give your future self more options rather than fewer. Let me give you an example. Many individuals who save for retirement imagine the freedom and leisure they will experience once they can leave their jobs. At that moment, they can't fathom feeling any differently. However, as retirement draws closer, some people realize that they want to continue working, even if it's just part-time, for reasons like the extra income, intellectual stimulation, or social interaction. Of course, there are situations that might push you into retirement sooner than you anticipated. It could be a health event that limits your ability to work, or perhaps you unexpectedly receive a large sum of money that allows you to cut short those last few years of your career. Furthermore, as I mentioned earlier, your desires and interests in life will naturally change over time. You might develop an expensive hobby or develop a passion for travel and want to explore new countries. These evolving preferences can have an impact on your financial situation during your golden years. The key takeaway here is that with enough savings, you'll have more options at your disposal. You can choose to retire, work part-time, work full-time, take a break and return to work, or even start your own business. However, if you haven't saved enough, you might find yourself with limited choices and the necessity to keep working. Therefore, it's crucial to be mindful of the end-of-time illusion and ensure you're setting aside sufficient savings for the future. By doing so, you'll be better equipped to adapt to changing circumstances and have the freedom to make choices that align with your evolving priorities and desires. Our natural inclination to prioritize immediate rewards over long-term benefits, even when waiting would lead to greater gains, is commonly referred to as inaccurate discounting. We all know we should save more for retirement, pay off debt, or build an emergency fund. However, in the heat of the moment, we often find ourselves wanting to spend our money on other things. But here's the interesting part. We can actually harness the power of inaccurate discounting to create positive outcomes. Behavioral economists have developed interventions where individuals commit to saving a portion of their future raises. The idea behind this approach is that saving future income seems more appealing than giving up current income. And guess what? The economists were right. Companies that implemented this strategy saw increased participation rates and contribution levels in their retirement plans. A similar concept is automatic escalation, commonly seen in many 401(k) plans. You have the option to sign up for automatic contribution increases in the future, such as a 1% raise each year. In fact, some plans make automatic escalation the default option. Furthermore, the IRS offers a Save More Tomorrow plan, where you can split your next tax refund, depositing part into your savings account and the remainder into your checking account. Ideally, we would always make rational decisions and consistently act in our best long-term interest. However, the reality is that we are not always perfectly rational, and we can't always rely on ourselves to make the smartest choices. That's where these workarounds come in. By leveraging these strategies, we can improve our financial outcomes and make wiser decisions with our money, even when our natural instincts might lead us astray. Imagine you're searching for tickets for your upcoming vacation when suddenly a message pops up on the screen. Only 3 seats left at this price. Instantly, you feel a sense of urgency. Quickly grab your wallet and enter your credit card information, hoping you didn't make a hasty decision. This powerful psychological trick at play is known as the scarcity effect, and it has been used for ages to influence our perception and behavior. A fascinating study conducted in 1975 sheds light on the impact of scarcity on our perception. Researchers placed 10 cookies in one jar and only 2 cookies in another. Participants were asked to rate the taste of the cookies. Surprisingly, the cookies from the 2-cookie jar received ratings twice as high as those from the 10-cookie jar, even though they were exactly the same cookies. The scarcity effect taps into the basic economic principles of supply and demand, suggesting that the rarer an item becomes, the more valuable it appears to us. This phenomenon is frequently observed in the housing market. When the number of available houses becomes limited, people become willing to pay significantly more than the market value, as they perceive the remaining inventory as more valuable. It's a clever tactic used by marketers to push us into impulsive buying decisions without carefully considering the logic behind our actions. Understanding how the scarcity effect works can not only save you money, but also boost your income significantly. On the spending side, when you feel that sense of urgency and tightness in your chest, ask yourself whether this is genuinely the last opportunity to acquire the item you desire. By removing emotions from the equation, you can make decisions that align with your best interests and avoid unnecessary spending. On the income side, harnessing the scarcity effect can be immensely powerful. If you own a business, creating a sense of urgency to motivate customers to purchase your products is an obvious strategy. However, even as an employee, you can leverage this effect. Let's say you work as a sales agent in a tech company, and your skills are on par with your colleagues. There may not be a compelling reason for your employer to pay you more than others. Now, imagine your company suddenly secures a contract with a large French company, seeking to buy $25 million worth of hardware annually. Being the only French speaker in the company, you possess a unique skill set that becomes incredibly valuable. Moreover, French is not a commonly spoken language in your city, making it challenging to replace you. Suddenly, you become a scarce resource for your business, and your employer will recognize the need to place a higher value on your contributions. This presents an opportunity for you to negotiate a higher salary or a more substantial bonus, ultimately increasing your income. Therefore, while perceiving something as scarce can sometimes lead to impulsive spending based on emotions, when you can harness this effect to your advantage, it can be a remarkably powerful tool. By understanding how scarcity influences our behavior, you can make informed decisions and strategically use it to achieve better financial outcomes.